You thought you were trading price, candles, indicators, green and red lines blinking on a screen like a video game. But what if I told you none of that is real? What if I told you that every losing trade you've ever made wasn't your fault because you never actually saw the game? Imagine for a moment that underneath every chart you've ever looked at is a hidden skeleton, a structure, a language the market speaks fluently, while retail traders try to interpret the noise. And unless you learn to read it, you're not trading. You're gambling with a blindfold on. Welcome to Trading Psychology Stick, where we decode the hidden patterns that move markets. Quick disclaimer, what you're about to learn isn't financial advice. It's educational content designed to transform how you see price action. Your results depend on your application, discipline, and risk management. Here's the paradox that keeps most traders broke. The more indicators you add, the more you distract yourself from what's actually moving the market. Because price doesn't move randomly, does it? It moves with intention. And that intention is always expressed through structure. Structure is not a tool. It's not a tactic. It's the foundational language of the market. The thing institutions use to build positions while retail traders chase ghosts. Let me ask you something. Have you ever seen price break a key level only to reverse violently and leave you stuck on the wrong side? That wasn't bad luck. That was structure doing its job, grabbing liquidity, completing a pattern, shifting character. While you were reacting to a breakout, the market had already made its decision 5 swings ago. That's how professionals think. They don't chase, they don't predict, they read. And now, so will you. Because this series isn't about setups, it's about sight. And by the end of it, you'll see markets differently. You'll see the swings, the breaks, the pivots. Most importantly, you'll see the story they're telling. Forex or crypto, doesn't matter. Structure is universal. It's the language of price. And it's time you learn to speak it fluently. Section 1. Structure is truth, the skeleton beneath every market. The market doesn't move because of headlines, emotions, or your favorite indicator. It moves because of structure. And structure is not a trend line or a fancy tool. It's the bones of the market, the framework, the underlying architecture that reveals how price breathes, expands, contracts, and finally commits. Most traders never see it. They're distracted by the drama, the breakout, the spike, the green candle that makes their heart race. But professionals, they see the skeleton, and that's why they win. Imagine you're watching a trader open his chart. Bitcoin is pumping hard. He panics. He buys. The next hour it crashes. Again, he blames the market, doesn't he? But zoom out, and a different picture emerges. What looked like a breakout was actually a liquidity sweep above a key high. The final grab before the real move down. The structure was clear. Higher low, failed continuation, shift in character. It wasn't noise. It was a message. But the message only reveals itself to those who know where to look. Structure begins with 3 simple ideas: swing highs, swing lows, and the sequences they form. When price makes a higher high followed by a higher low, it's trending up. When it makes a lower high followed by a lower low, it's breaking down. That's it. This is not theory. It's not strategy. It's how every market breathes. And yet, most ignore it. They rely on indicators to interpret what structure already told them 3 candles ago. But here's the secret. The market never changes direction randomly. It transitions. And that transition is visible through break of structure, through change of character, through liquidity behavior. The skeleton speaks first, always. And if you listen closely, you'll notice something magical. Price doesn't lie. It's just that most traders don't understand what it's saying. Take a moment to reflect. How many times have you entered a trade based on how you felt, rather than what the structure showed? If you're honest, probably more than you'd like to admit. Comment below with one word that describes your biggest trading struggle. Is it patience, discipline, fear? Let's build awareness together. Institutional traders, the ones who actually move price, don't guess. They track structure. They let retail chase the top, buy the breakout, sell the dip. Meanwhile, they wait for the sweep, the BOS, the CHoCH, the shift. They enter where retail exits, and they hold where others panic, because structure tells them when the story has changed. So the question becomes clear: can you learn to read it? Can you train your eye to see beyond the candle and into the anatomy of the market itself? Because once you do, trading stops feeling like guessing. It becomes recognition, pattern, precision. Not because you're predicting, but because you're following what's already been written. The skeleton is there. It's always been there. Now let's learn to see how it moves, how it breathes, and most importantly, how it tells you exactly where price wants to go next. Section 2. The language of trend. How structure tells you where price wants to go. Every trader wants to know where the market is going, but few realize the market has been whispering the answer all along through trend. Trend isn't a line on a chart. It's a sentence in the market story, and that sentence is written in the sequence of higher highs and higher lows, or lower highs and lower lows. Once you understand this, you stop trading in isolation. You start reading in context. Imagine you're watching ETH in early 2024. It had rallied for days, every dip getting bought, every breakout pushing higher. But one day, it pulled back deeper than usual. It bounced, yes, but it failed to break the last high. Then it dropped, hard. Traders who bought the dip again got caught. But this time, it didn't bounce. It broke the last low, and many got liquidated. Why? Because they were trading yesterday's trend. They weren't reading today's structure. The market had shifted from bullish sequence to bearish transition, and they ignored the grammar of trend. Trends are structure in motion. An uptrend is a dialogue. Buyers are in control, and it keeps repeating until something interrupts that rhythm. A failed high, a break of a key low, a shift in character. That's when the market whispers, the story is changing. But most traders aren't listening, are they? They're hoping, guessing, copying. Now, let me share something that changed my perspective forever. Trends aren't just direction, they're psychology. An uptrend means buyers are confident. A downtrend means sellers have conviction. A sideways range means indecision. But within each of these, structure leaves footprints. Compression before breakout, sweep before reversal, clean swing continuation. It's all there. If you know how to look, when you learn to read trends structurally, you gain something priceless: timing. You know when to follow, you know when to stand aside, and most importantly, you know when to prepare for the reversal before it happens. Not after the damage, not after the loss, but right at the moment when structure hesitates. And that's why indicators lag. They wait for confirmation, but structure is the confirmation. It tells you when flow shifts, when imbalance returns, when the market is no longer in agreement. That's when the smart money leans in. That's when setups actually matter. Think about the power of this. While others are still wondering if the trend has changed, you already know. You saw the failed high. You noticed the deeper pullback. You recognize the character shift. You're not guessing anymore. You're reading what's already written in the language of swings. So, next time you look at a chart, don't just ask, where's price going? Ask yourself, what phase of structure am I in? Because once you see trend as structure, not direction, you stop fighting the market. You start flowing with it. But what happens when that flow breaks? When the sequence shifts? When structure stops telling the same story and starts writing a new one? That's where the real opportunities hide. And in the next section, we'll master the art of spotting these transitions before everyone else even knows the story has changed. Section 3, when structure breaks, mastering BOS, CHoCH, and the lies the market tells. The market rarely screams when it's about to reverse. It whispers. And if you're not tuned in, you'll miss it. What separates pros from amateurs isn't who has the better entry. It's who recognizes when the entire character of the market just changed. That shift has two names: break of structure and change of character. But here's what they don't tell you. Sometimes structure lies. Let's set the stage. Imagine you're watching EUR/USD on the 4-hour chart. It's been bullish for weeks. Classic higher highs, higher lows. Every dip is a gift. Then one day, price fails to make a new high. It pulls back deeper than usual. You still believe. So, you buy the next low. But instead of bouncing, price breaks the most recent swing low. Clean. That's a break of structure. And that's your first whisper. The flow is weakening. But here's the twist that catches everyone off guard. A BOS can happen inside a continuation. It doesn't always mean reversal. That's where change of character comes in. CHoCH is the first time the market switches polarity. When a downtrend suddenly creates a higher high, or an uptrend breaks and makes a lower low, it's the moment the story breaks pattern. And if you're listening, you realize something powerful. Structure has stopped continuing. It's starting to resist itself. Now, let me blow your mind with something most educators won't tell you. Structure failures. These are the times when the market sets up a perfect BOS or CHoCH, only to fake everyone out. Picture this scenario. Bitcoin shows a bullish structure, HH, HL, momentum up. It breaks above a recent high. Traders enter. But instead of continuing, price pauses, wicks, then collapses, breaking the last low in a single brutal candle. They're confused, but it broke structure. Wasn't that a continuation? No, that was a liquidity trap disguised as a BOS. A false continuation before a major reversal. Most retail traders miss this completely. They see a BOS and think, it's just a pullback. They see CHoCH and assume it's noise. They see a structure failure and blame bad luck. But structure doesn't break without reason. Behind every shift is an imbalance in liquidity, sentiment, or narrative. And those who read these nuances don't just get in early. They position themselves where others get trapped. Here's what you need to understand. CHoCH is not a signal. It's a statement. This is no longer what it was. And the best entries happen right after CHoCH during the retest, when the new structure proves itself. That's where conviction lives. That's where asymmetric risk appears. But how do you spot when structure is lying? 3 things to watch for. First, lack of follow-through. Price breaks structure, but stalls immediately. No volume, no conviction. Second, aggressive rejection, fast wick rejections, or engulfing candles immediately after a break. Third, liquidity context. The break happens into a known liquidity pool like equal highs, not beyond it. Pause for a moment and ask yourself, how many times have you held on to a losing position because you couldn't accept that character had changed? Or worse, how many times did you exit a winning position because you fell for a fake structure break? If you're finding value in understanding these shifts, type structure in the comments. It helps me know what resonates with you. Smart traders use structure breaks as a filter, not a trigger. If a BOS fails, they don't double down. They observe. Is price rejecting cleanly? Is the reaction emotional? Are others trapped? If so, they know the real move is coming in the other direction. They fade the fake and ride the real. And that's the paradox of structure. You must trust it enough to build your edge and doubt it enough to protect yourself from traps. It's a dance. And the best traders aren't rigid. They adapt. They let the market lead, and they follow with precision. Think of it like a chess game. You study the patterns. But when your opponent blunders, when they make a move that breaks every known tactic, that's your opening. Structure failures are blunders. They're windows into the market's emotional core. And if you stay present, they guide you straight into high probability reversals. So the next time you see structure break, don't react. Respond. Ask yourself, is this a genuine shift in market character, or is this the market hunting for something? Because once you understand both the truth and the lies, structure tells, you're no longer trading patterns. You're trading intention. But structure doesn't move on its own. It's driven by something deeper, a hidden force that moves price not based on value, but based on need. And in the next section, we'll uncover the dark heart of the market, the liquidity that fuels every trap, every spike, every fake out you've ever experienced. Section 4, liquidity, the market's hunger for your stop loss. You were never the target. Your stop loss was. Most traders think the market is trying to go somewhere. It's not. It's trying to find someone, the person who's most vulnerable, most convinced they're right, most willing to give up control. That person is usually you. And the thing they want? Liquidity. Your exit order. Your emotional breaking point. Because in truth, the market doesn't move to reward smart traders. It moves to fill the needs of those who control the game. And they need liquidity to enter. Imagine you've identified a clean resistance zone. Price has tapped it twice. Everyone sees it. You go short on the third touch, confident. But what happens? Price breaks above it. Your stop gets hit. You rage. Then it collapses hard. You were right and still lost. That wasn't manipulation. That was liquidity harvesting. Now picture this from an institutional perspective. They have millions to deploy. They can't just market buy without moving price against themselves. So what do? They engineer liquidity. They push price into obvious stop-loss zones, collect the orders, then reverse. It's not personal, it's structural. Liquidity zones are areas where orders are clustered, equal highs, clean lows, obvious breakouts. In those zones sit thousands of traders just like you, waiting, hoping, reacting. And institutions know it. They don't chase price. They create the illusion of movement to trigger your reaction. Once they have your liquidity, they move in the opposite direction. It's not evil, it's structural. Like a lion stalking a herd, it waits for the weak to step out. Then it strikes. But here's what makes this even more powerful. Liquidity creates the very structure breaks we just discussed. That false BOS, it was grabbing liquidity above the high. That failed CHoCH, it was sweeping stops below the low. Structure and liquidity are married. You can't understand one without the other. Smart money doesn't buy dips. They buy after the sweep. They don't sell breakdowns. They sell into the breakout. Because they know, before any real move happens, the market must clear the weak hands. This is why so many breakouts fail, because breakouts aren't designed to free you. They're designed to trap you. Structure without understanding liquidity is a half-built map. You see the trail, but not the cliffs. And this is where things get deeper, because liquidity isn't just horizontal, it's emotional. Every time you set a stop loss, you expose a part of your psychology. The market doesn't just take your money, it takes your confidence. It feeds off your certainty. That's why the best traders aren't just technical. They're patient. They wait for the sweep, the shift, the reclaim. Only then do they act. Case in point, the 2017 Bitcoin run to 20K. Remember the exact top? Price wicked above 20K, grabbed all the euphoric longs, then crashed 70% over the next year. That wasn't random. That was a liquidity event at a psychological number. The market found its fuel and used it to reverse. Here's a mental shift that will transform your trading. Start seeing stop losses not as your protection, but as the market's target. Once you understand this, you'll start placing them differently, beyond the obvious, behind the liquidity, where the real protection lives. So next time you see a clean level, ask yourself, who's on the other side? Is this a real break or a baited hook? Because once you understand liquidity, you stop trading levels and start trading behavior. You stop being the hunted and start thinking like the hunter. And yet, even when you understand structure and liquidity, you're still half blind. Because these patterns play out differently across time. What looks like opportunity on one time frame might be a trap on another. And in the next section, we'll unlock the multi-dimensional view that separates amateur traders from professionals. Section 5. Multi-time frame mastery. Seeing the complete story. The market is a fractal, a story told at different speeds. What looks like chaos on the 1-minute chart might be a perfect pullback on the 1 hour. What feels like a breakout on the daily might just be a fake out on the weekly. And yet, most traders treat every chart like it's the only truth. They zoom in, take the trade, and wonder why the market felt like a trap. But the trap wasn't in the price, it was in your perspective. Multi-time frame structure is how pros see the market in layers. They don't just ask, where's the next candle going? They ask, what phase is this chart in within the larger structure? It's like reading a sentence in a novel. You can't understand the meaning unless you know the chapter. Imagine a trader looking at GBP/JPY on the 15-minute. He sees a bullish CHoCH. He buys. It looks clean. Structure shift, momentum up. But what he doesn't see is that the 4-hour is in a confirmed downtrend and that 15-minute shift. It's just a retracement into a bearish order block. He gets stopped out. Not because his analysis was wrong, but because it was incomplete. He was trading a sentence without knowing the plot. Here's something that transformed my trading forever. Professionals define a dominant time frame, usually H4 or daily, to determine bias. Then they drop to lower time frames, M15, M5, to fine-tune entries. The lower time frames give the trigger. The higher time frames give context. You don't trade the M5 just because it shifted bullish. You trade it when the M5 aligns with a bullish structure on H1 or H4, and when liquidity has already been swept. This alignment creates what smart money calls confluence. A higher time frame, BOS, plus lower time frame, CHoCH, plus liquidity sweep equals asymmetric opportunity. It's not about sniper entries. It's about reading the bigger frame and entering when structure agrees on all levels. The trade doesn't just look right, it feels inevitable. Think about it like weather forecasting. If the weekly chart is a storm system, the 1 minute is a gust of wind. Would you open an umbrella because a breeze blew past? Or would you check the radar first? Every time frame gives you a slice of truth, but only when stacked together do they reveal the real story. If you've ever been stopped out on what looked like a perfect setup, only to watch price move in your direction afterwards, drop a time in the comments. You're not alone. We've all been there. The key is learning from it. And this matters more than ever in fast markets like crypto. BTC might look bullish on the hourly, but zoom out and you'll see it's simply retesting a broken weekly support. That's how people get trapped. They zoom in, feel confident, and forget the larger war being waged above their screen. But here's the real secret. Time frames don't just show you different views, they show you different players. The 1-minute chart, that's noise traders and algorithms. The 4-hour, that's position traders. The daily and weekly, that's where institutions build campaigns. When you understand who's playing on each time frame, you understand why moves happen when they do. So, before you enter any trade, ask yourself 3 questions. What does the higher time frame say? Is this entry flowing with the dominant structure or fighting it? Is this setup appearing at a key inflection point or in the middle of nowhere? Because structure exists on every time frame, but edge exists when they all align. When the weekly shows accumulation, the daily shows a bullish shift, and the hourly gives you a clean entry after a sweep. That's not luck, that's multi-dimensional thinking. And once you master seeing the market in layers, something else becomes clear. Structure doesn't just exist in space, it exists in time. And in the next section, we'll decode why when you trade matters just as much as what you trade. Section 6, timing in sessions, why when matters as much as where. You could have the perfect setup, a clean CHoCH, a textbook BOS, liquidity swept, time frames aligned, and still lose. Why? Because the market doesn't just move based on structure, it moves based on when that structure appears. Timing isn't optional, it's everything. You see, the market is like a theater performance. The same scene, the same dialogue, hits differently depending on when it happens. A bullish CHoCH at 2 a.m. might be noise, but the same move at London Open, that's a statement. The players are different, the stakes are different, and most importantly, the liquidity is alive. Every trading day breathes in sessions. Asia, London, New York. And each session has a rhythm. Asia creates the range, London breaks it. New York either extends or reverses. And smart money knows this. That's why they don't just look for setups. They wait for the right moment to strike. Here's a pattern I've observed countless times. A trader sees a sell setup on EUR/USD during New York lunch. Low volume, quiet market. The CHoCH is clean. The entry looks perfect. But price grinds sideways, stops him out, then dumps 2 hours later when volatility returns. The setup wasn't wrong. The timing was. He was early. And in trading, early is the same as wrong. Smart traders align structure with time. They wait for high-impact windows, 15 to 30 minutes after session opens, right before or after major news. End of week closes for trap exits. Because that's when the market is obligated to show its hand. That's when volume is real, stop hunts are active, and institutional flow is present. Structure means nothing if nobody's there to move price. Imagine watching a perfectly formed CHoCH at 3 a.m. EST. Clean break, good momentum. But who's trading? The skeleton crew, the market makers on autopilot. Now imagine the same setup at 8:30 a.m., 30 minutes after New York opens. Same pattern, completely different outcome. Why? Because timing determines participation, and participation determines power. One powerful concept in trading is the Judas swing. These are fake moves during the first hour of a session designed to trap early traders, only to reverse once enough liquidity is gathered. These traps happen on schedule, almost like clockwork, and once you see them, you never unsee them. But timing goes even deeper than sessions. It's about understanding the rhythm of the trading week, Monday's range creation, Tuesday and Wednesday's expansion, Thursday's momentum, Friday's positioning. Each day has its own character, its own tendencies. And when you align your trading with these rhythms, you stop forcing trades. You start flowing with the market's natural breath. Here's something fascinating. The best traders often take their biggest positions not when structure is cleanest, but when structure aligns with optimal timing. They understand that a B+ setup at A+ timing beats an A+ setup at C timing every single time. So, how do you build this into your trading? You don't just mark BOS or CHoCH. You timestamp them. You note the session. You track which times of day your edge performs best. Because patterns without timing context are just pretty pictures. And this brings us to a crucial realization. The market isn't just a technical machine. It's a living organism with moods, rhythms, and personalities that shift throughout the day. And in the next section, we'll explore how these moods, these waves of emotion, create the shifts that make millionaires and break beginners. Section 7. Sentiment and market shifts, when psychology creates opportunity. The market isn't made of lines. It's made of people. Behind every swing high is hope. Behind every stop loss is fear. Behind every breakout is a crowd of traders rushing in, thinking this time will be different. Structure shows you the pattern, but sentiment shows you the motive. And when you combine the two, you see something powerful. The exact moment when psychology shifts and opportunity is born. You've felt it before, haven't you? Bitcoin breaks all-time highs. Social media explodes. Everyone calls for 100K. You buy in, not because of structure, but because of emotion. Because the crowd made you believe this was the move. But what you missed was the sweep, the trap, the subtle rejection from the supply zone nobody wanted to acknowledge. 2 weeks later, price is down 30%. Sentiment drove you in. Structure never backed it up. The crowd is always loudest at the worst time. When price is euphoric, when volume is peaking, when headlines scream moon missions, that's when smart money exits. Why? Because mass sentiment is liquidity, and retail sentiment is predictable. It always chases, always panics, always overcommits. But here's what most don't understand. Sentiment doesn't just influence price, it creates the very structure shifts we've been studying. When fear reaches extreme levels, when everyone is convinced the world is ending, that's often when the market finds its floor. Not because of some magical support level, but because there's no one left to sell. The sentiment has exhausted itself. This is what we call a market structure shift. It's not just a CHoCH or a BOS. It's the combination of structure change with sentiment extreme. It's the moment the market completes a hidden agenda, sweeps the final liquidity, and then commits with conviction. Not just breaking a level, but declaring, the story has changed. Let me paint you a picture. Imagine watching Solana in early 2023. It had been dead for months, range-bound, forgotten. The sentiment was pure despair. It's going to zero. Another dead project. Then one day, it fakes a breakdown, takes out the lows. Everyone who still believed finally capitulates. But what happens next? Price reclaims the range, then breaks a clean lower high. Volume kicks in. Sentiment flips. That wasn't just a breakout. That was a market structure shift. Smart money had finished accumulating while sentiment was at its darkest. The trend was no longer down. It wasn't just a reversal. It was a declaration of power. A true market structure shift has 3 ingredients. First, a liquidity event. Price sweeps obvious lows or highs where emotional traders are trapped. Second, a break of the previous internal structure, often overlooked by retail still focused on the old narrative. Third, a clean, high-volume BOS in the opposite direction with conviction, not hesitation. Here's something profound. The best trades happen when structure and sentiment disagree. When the charts show bullish structure, but everyone is bearish. When price makes a higher low, but the crowd is screaming lower. That disagreement, that's your edge. Because one of them is wrong, and it's usually the crowd. Smart money uses structure to map the battlefield, and sentiment to predict where the next casualty will be. They look for long wicks at highs with euphoric news, sudden reversals right after bullish confirmations, panic selling into demand zones with no structural break. They fade the crowd, not emotionally, but structurally. And it's not just news or social media. Even price itself is tells. Fast, aggressive moves often indicate emotional imbalance, gaps, spikes, liquidity hunts. Those aren't organic. They're reactions. And every overreaction is a setup for reversal. Here's a quick exercise that will sharpen your sentiment radar. Next time you're about to enter a trade, pause and ask, what is the crowd feeling right now? What are they expecting? If your trade aligns with mass expectation, reconsider. If it fades the obvious, you might be onto something. Share your biggest crowd trap story in the comments. We learn from each other's experiences. So, how do you trade this? Simple. Map structure first. Then overlay the sentiment. Are you seeing a CHoCH into a news-driven panic? That's a gift. Is the crowd piling into a breakout before the BOS? That's a trap. You don't trade sentiment blindly. You use it to validate or invalidate what structure is suggesting. Because price doesn't move in a vacuum, it moves through people, through their fear, their greed, their doubt. And once you understand that, you stop being part of the crowd. You start trading them. But even with perfect structure, timing, and sentiment analysis, you're still vulnerable, because one thing can destroy even the best trader: poor risk management. And in the next section, we'll build your survival system for thriving in any market condition. Every candle on the chart is a story of someone risking too much and someone risking just enough. One gets wiped out. The other lives to fight another day. The difference isn't intelligence, it's survival instinct. Because in trading, you don't win by being right. You win by staying alive long enough for your edge to pay off. Structure shows you where opportunity lives. Risk management tells you how much of yourself to put into it. But here's the twist. Risk isn't static. It evolves, just like the market. And if you can't adapt your risk to changing conditions, even perfect structure becomes a death trap. Let's walk through a painful but common scenario. You spot the setup, liquidity swept, CHoCH confirmed, time frame alignment. You enter, and it works for a moment. But news drops, a flash move, spread spikes, price wicks down, tags your stop, and then rips in your direction. You're out, angry, frustrated. Then you realize you risked 10% of your account. You thought this was the one. Now you're emotionally compromised, sizing up the next trade to make it back. But the next trade doesn't work, neither does the one after. You're not losing to structure, you're losing to position size. And worse, you're not adapting to the market's changing personality. The best traders risk little, but compound a lot. 1 to 2% per trade, clean stop, predefined invalidation. But here's what separates survivors from casualties. They adjust their risk based on market conditions. Choppy market, smaller size, clean trending conditions, normal risk, major news week, reduced exposure. They're not rigid. They're responsive. Because structure gives you the stop. If you enter on a CHoCH after a liquidity sweep, your stop goes below the sweep. Simple. If structure breaks against you, you're out. No negotiation, no, let me give it space. But the size of that position, that depends on the market's current behavior. Think about it like driving. You don't drive the same speed in a storm as you do on a clear day. The road is the same. Your destination is the same. But the conditions demand adaptation. Trading is no different. And this adaptability extends beyond just position sizing. It's about recognizing when the market itself has changed. Remember the 2020 to 2021 crypto bull run? Structure was clean, trends were powerful, every dip was bought. Then came 2022. Same pattern started failing. CHoCH entries that printed instantly before now chopped sideways. Liquidity sweeps went deeper. The market's personality had shifted. Rigid traders kept trading the old playbook, bleeding slowly. Adaptive traders recognized the regime change. They widened stops, reduced frequency, waited for cleaner setups. Some even stepped aside completely, preserving capital for when conditions improved. That's not weakness, that's wisdom. Here's how you build an adaptive risk system. First, categorize market conditions: trending, ranging, volatile, quiet. Then assign risk parameters to each. Trending markets might get full 1% risk, choppy conditions might get 0.5%. News-heavy weeks might mean no trading at all. Second, track your performance in different conditions. You might discover you excel in volatile breakouts but struggle in quiet ranges. That's valuable data. Trade larger when conditions favor you. Trade smaller or not at all when they don't. Third, build evolution into your process. Every month, review not just your trades but the market's behavior. Has volatility increased? Have patterns changed? Are sweeps getting deeper? Let the market teach you how it wants to be traded right now, not how it was traded last year. Because here's the brutal truth. The market doesn't care about your system. It doesn't care about your back tests. It evolves, and you either evolve with it or become extinct. But when you combine solid risk management with intelligent adaptation, you become anti-fragile. You don't just survive market changes, you thrive on them. Great traders aren't afraid to lose. They're afraid to not adapt. One loss should teach you something. One changed condition should refine your approach. Because in this game, it's not the strongest who survive. It's the most adaptable. And that adaptability isn't just external. The biggest evolution happens inside you. In the next section, we'll master the inner game that turns good traders into great ones. Section 9, the inner game. Mastering Your Psychology for Consistent Execution. You can read the structure perfectly, spot every CHoCH, every BOS, every liquidity sweep before it happens. Your timing can be impeccable, your risk management flawless. But when the moment comes, when your money is on the line and your heart rate jumps, all that knowledge vanishes if you can't control one thing: yourself. Because the truth is, most traders don't lose to the market. They lose to their emotions about the market. Fear, greed, doubt, overconfidence. These aren't side effects. They're the invisible traders sitting next to you, clicking your mouse before your logic has time to speak. Picture this internal battle. A trader sees a perfect setup. Structure is aligned, liquidity has been swept. Time frame confluence is clean. He's waited days for this exact pattern. But when price approaches his entry, he hesitates. His brain floods with, what if? What if it fails like last time? What if this candle wicks me out? What if it keeps running after I take profit? He hesitates. Price moves without him. He watches. Then, frustrated, he chases late. It reverses. He loses. Not because of his analysis, but because of the voice inside that hijacked the moment. But here's what separates professionals from amateurs. Emotional control isn't about suppressing feelings. It's about understanding them, noticing when fear is trying to protect you from imaginary pain, or when greed is whispering that this one's the big one. Because those voices will always be there. But structure gives you something they don't: neutral truth. Either price broke structure or it didn't. Either we swept liquidity or we didn't. Your job is to anchor to that truth and act from it. And this is where growth mindset becomes your superpower. Every loss isn't a failure, it's data. Every emotional hijack isn't weakness. It's information about where you need to strengthen. The best traders aren't built in bull runs. They're forged in the quiet hours after a stop loss, in the reflection after a strategy stops working. You stop saying, "I'm not good at this," and start saying, "I haven't mastered this yet." You stop thinking, "This setup failed," and start thinking, "This setup revealed something I missed." You stop chasing confidence from results and build it from process. I've noticed something powerful in my own trading. When I feel that emotional surge, that urge to chase or freeze, I literally say out loud, "What does structure say?" It's like a reset button. Try it. Next time you feel the heat rising, ask the question. Let structure be your North Star when emotions want to steer you into the rocks. Top traders have routines, pre-trade checklists, journals. They don't rely on how they feel. They rely on how the structure behaves. They know their weak spots. They have rules for when to walk away. Some only trade certain sessions. Some limit trades per day. Not because they're weak, but because they're disciplined. And discipline is what makes structure powerful. Here's how you build unshakable psychology. First, journal every trade, not just outcome, but emotion. Rate your clarity. Did you follow the plan? Did fear hijack you? What was your internal dialogue? This isn't about judgment, it's about awareness. Second, visualize scenarios in advance. See yourself executing perfectly when price approaches your entry. See yourself taking the stop calmly if structure fails. Mental rehearsal builds emotional muscle memory. Third, create state management rituals. Maybe it's 3 deep breaths before opening your charts. Maybe it's reviewing your rules out loud. Maybe it's a specific playlist that centers you. Whatever works, make it consistent. Because consistency in preparation leads to consistency in execution. Because in the end, structure isn't just a map of the market. It's a mirror of your mind. If you can't hold your psychology steady, even the best setup becomes sabotage. But when you master the inner game, something magical happens. You stop reacting to the market. You start responding to it. You stop being controlled by price. You start dancing with it. And this brings us to the final piece of the puzzle, because all of this knowledge, all of these insights mean nothing without implementation. In our final section, we'll transform theory into practice, turning you from student to practitioner. Section 10, From Knowledge to Mastery, Your Path Forward. Most traders treat the chart like a prediction machine. They stare at the present, try to guess the future, and hope they're right. But the traders who last, they don't look forward, they look back. Because hidden in the past are patterns that repeat with eerie precision if you know how to see them. And the bridge between knowledge and mastery isn't a secret system, it's deliberate practice. You've learned the language of structure. You understand BOS and CHoCH. You see liquidity. You respect time. You read sentiment. you manage risk. You've even begun mastering your psychology. But here's the truth. None of that matters until it becomes automatic, until recognition becomes reflex. This is where backtesting becomes your secret weapon. But not the way most do it, looking for wins and skipping failures. True structure-based backtesting is different. You study both the wins and the failures. You ask specific questions. Did this CHoCH form after a liquidity sweep or in the middle of a range? Was there follow-through after BOS or hesitation? What time did this structure shift happen? What session? What was the sentiment context? You're not testing a system. You're training your perception. Here's your homework, and yes, this is where the rubber meets the road. Tonight, open your charting software, pick any pair, go back 3 months, find 5 CHoCH patterns, screenshot them, note the time, the session, what happened next. Do this for 30 minutes. That's it. Small steps create big shifts. Comment, ready, if you're committed to doing this tonight. But backtesting is just the beginning. The real transformation happens through reflection. Every week, review not just your trades, but your evolution. What patterns are you seeing more clearly? Where is structure speaking loudest? What market conditions favor your developing edge? This is what reflection gives you: perspective, pattern recognition, emotional detachment, and most importantly, structure inside your own evolution. You journal not like a diary, but like a detective, building a case file on your own growth. And here's what nobody tells you. Mastery isn't a destination. It's a practice. The market will evolve. Conditions will change. What works today might fail tomorrow. But if you've built the foundation of reading structure, managing risk, controlling psychology, and constant adaptation, you don't just survive these changes, you profit from them. Because at the highest level, trading isn't about predicting. It's about responding. It's about being so aligned with market structure that you move with it, not against it. It's about being so clear on your process that emotion can't derail you. It's about being so adaptive that no market condition catches you off guard. The path forward is simple, but not easy. Every day you practice seeing structure. Every trade, you practice discipline. Every loss, you practice learning. Every win, you practice humility. Because the market is the ultimate teacher, but only if you're willing to be the eternal student. So, where do you go from here? You don't need another course. You don't need a magic indicator. You need repetition. You need to put in the hours watching structure unfold. You need to experience the patterns until they become part of you. You need to fail enough times that fear loses its grip. You need to win enough times that confidence becomes quiet certainty. The market doesn't need you to be perfect, just present, structured, and consistent. If you've made it through this journey, chapter by chapter, pattern by pattern, insight by insight, then pause for a moment. Let it land. You've learned that structure is not a tool, it's a language. You've discovered that CHoCH and BOS are not just acronyms. They're the heartbeat of price. You've explored how liquidity isn't chaos. It's intention disguised as noise. You now see that timing is everything, sentiment is energy, and adaptability is your oxygen. But most importantly, you've started to turn trading from a reaction into a ritual. So now the question isn't, what should I trade this week? The real question is, who am I becoming through this process? Because trading doesn't just reveal the market, it reveals you, your fears, your patterns, your control issues, your growth. And here's the challenge. Don't just watch this video. Don't just nod at the insights. Do something. Now. Pull up your last 5 trades. Look at the structure before each one. Was it aligned? Was the CHoCH clean? Was the BOS confirmed? Write 1 sentence per trade. Here's where I honored structure. And here's where I ignored it. This isn't about judgment. It's about awareness. Because awareness is where change begins. And change is where edge lives. Then comment below, I'm now trading with structure. Here's what I'm changing. Be specific. Maybe it's, I'm adding time frame confluence checks. Maybe it's, I'm waiting for liquidity sweeps before entering. Maybe it's, I'm journaling my emotions, not just my trades. Whatever it is, declare it. Let this be your public reset, your new standard. You're not here to be a signal follower. You're here to be a structure reader. You're not here to predict the market. You're here to listen to it. You're not here to feel in control. You're here to respond with clarity. So let this be your edge, not the system, but the site, not the setup, but the structure, not the prediction, but the patience. And remember, structure is the story, liquidity is the twist, your mindset is the author. Now, go back into the market and write a better chapter. Welcome to the journey. The real work starts now.